Welcome back. We're speaking with David Sykes, Chief Investment Officer at TD Asset Management. David, we just talked about sort of the landscape and the backdrop for us as investors. Let's talk about the investment strategy for this year. Yeah, so from TD Asset Management perspective, I think it's fair to say that with the backup in yields, we're actually favorably positioned towards fixed income. I think from our perspective, we view it as a situation where yields are attractive. You can put together a fixed income portfolio, high fours, low fives in terms of percent, in terms of yield. And so we're overweight fixed income. We're overweight government bonds. We're also overweight high quality corporate debt. Not quite there yet on high yield. I think the spreads have a little bit further to widen. On the equity side, we've got a modest underweight position. Modestly underweight Canada. Lots of issues in terms of debt, at the consumer level in the country, concerns about housing. Likewise, in the U.S., we talked about valuations. We think they're a little stretched. We think we could see some more compression there. We do like China. We're overweight China on the reopening play. I think we've seen lots of good economic data there, and valuations were very reasonable to cheap. So, overweight on the fixed income side, underweight on the equity side. And then in our alternatives business, I think that's a really important area for investors to focus on. Not necessarily available to all investors, but if we think about real estate, industrial real estate, multi-unit residential, office, we think that's a very important part of a portfolio, in addition to our private debt offerings and our private mortgages. And so we're roughly neutral that space, a little bit underweight on the domestic real estate side. There may be a few bumps in the Canadian economy, but we're quite positive on private debt and overweight on the mortgage side. Obviously, as a strategy, after the year that we had last year, the fixed income portion makes a lot of sense for the reasons you laid out. You got a coupon that's actually giving you a nice yield. You're looking at the end of the rate hiking cycle. What are the risks to that strategy? There are always risks, right? Yeah, so look, there are always risks. And I think in my mind, there are basically two big risks. The first risk is the risk of what we don't know. We didn't know that COVID was coming. We didn't know that all of that stimulus was going to lead to, skyrocketing inflation. So there's always the risk of the unknown. But I think, to me, the big risk is really inside the labor market. The issue here is labor going to continue to be so strong? Right now, unemployment, after all these Fed hikes, after all the Bank of Canada hikes, unemployment in Canada is at 5%, and the United States is at 3.5%. That's really where the inflation battle is going to be won or lost. And I think the big risk here is labor markets stay tighter for longer. Wages and salaries are a huge component of services, and if that continues to move higher, I think we've got real concerns for higher rates and what that does for valuations as we go throughout 23. So you got a base case, you got some risks there. If an investor is trying to figure out how to put it all together to sort of protect themselves, particularly after last year, right? So a lot of people are just like, I just want to do all right this year. How do you do that? How do you protect yourself? So to me, it always sounds trite and it sounds simplistic, but if we're talking about the next 3 hours, 3 days, 3 weeks, that's a real difficulty. Yeah. But if we've got a reasonable time frame as a long-term investor, I think it's a much better environment today than it was, say, 2 years ago. Valuations when the market was at all-time highs were not reasonable. I think today the way you protect yourself is really three things. It's quality, quality, quality. It's quality corporate bonds. It's quality equity investments that companies generate cash, return that cash. And the same thing on our real estate side, it's Class A office. It's, making sure the underwriting standards of our private mortgages are very well covered. It's quality, quality, quality. And, most investors I find with a long-term perspective, that's what they're after. And that approach will get you to their goal. There are ups and downs, but a lot less volatility than other paths you could choose. Always a pleasure to get your insights, David. Thanks for joining us. Thanks, Greg. David Sykes is Chief Investment Officer at TD Asset Management. Still ahead, we're going to talk real estate, specifically the office space, and what the whole work-from-home model could mean for the sector.